Forget stocks for a minute. Forget crypto. Today, we are talking about the one asset that has outlasted entire empires, survived every single financial crisis, and sits in the vaults of every central bank on this planet. Yep, we're talking about gold.
Just think about it for a second. Stock markets can absolutely crash. Real estate can grind to a halt. And currencies, well, they slowly lose their buying power over time. But through all of that chaos, one timeless asset has always survived. And you know what that is?
You know, we've all felt that horrible pit in our stomach when we look at our portfolio and it's just bleeding red, right? During high inflation, a recession, or just pure market panic, our natural instinct is to run for safety. We start looking for a safe harbor, something stable when everything else feels like it's sinking.
And that search for safety, it almost always leads us back to the same place. But what is it about gold that makes it so special? Why, for literally thousands of years, have we instinctively turned to it when things get rough? Well, let me break it down for you.
It's because gold's value isn't just about it being some shiny, pretty metal. Its real value is rooted in something much deeper. Think of it like a timeless financial anchor in a sea of volatility.
This slide right here really gets to the core of it. We're not just talking about a commodity. We're talking about a global symbol of trust. I mean, the U.S. Federal Reserve, the People's Bank of China, our own Reserve Bank of India, they all hold massive gold reserves. Why would they do that? Because it's the ultimate financial backstop. It survived wars, depressions, you name it. When everything else is up in the air, gold just represents stability.
Now, to really understand gold's role in your portfolio, you need to understand one key term, a hedge. Now, the technical definition is, it's an investment meant to offset potential losses in another part of your portfolio. Okay, so what does that actually mean in plain English?
Think of it like this. Gold is your financial shield. It's a hedge against inflation slowly eating away at the value of your cash. It's a hedge against the gut-wrenching uncertainty of a market crash, and, it's a hedge against pure, widespread panic. When fear is running high, gold tends to shine the brightest.
Okay, so you're sold on the why. Now, let's get to the how. Investing in gold today isn't just about going to the jeweler anymore. There are some really smart, efficient ways to add it to your portfolio. So let's check out the options.
So how do you actually own gold these days? This table breaks down the main options. You've got your classic physical gold, coins and bars. It's tangible, you can hold it in your hand, but then you got to worry about storing it safely, insurance, all that stuff. Then there's digital gold. Super convenient, for sure, but you have to watch the costs and it's not as regulated. But honestly, for most modern investors, the real choice boils down to the last two: sovereign gold bonds or SGBs and gold ETFs.
Okay, this is the big decision for most of us, and it's actually pretty simple. Think of it like this. Sovereign gold bonds, or SGBs, are for the long-term investor, the buy and hold crowd. Not only do you benefit if gold prices go up, but the government actually pays you 2.5% interest every year. Plus, the big one, if you hold them for the full 8 years, your gains can be tax-free. On the other hand, gold ETFs are all about flexibility and trading. You can buy and sell them just like a stock, anytime the market is open. They're perfect if you want to be more active. So you just have to ask yourself, am I building long-term wealth, or am I looking for a short-term trade?
All right, now for the million-dollar question. How much gold should I actually have? Because look, it's not about going all in. It's about finding that sweet spot, the right balance for your overall portfolio.
The general expert recommendation is to base your allocation on your age and how much risk you're comfortable with. So for younger investors who have a lot of time, about 5 to 10% is a really solid defensive play. As you get a bit older, maybe more conservative, that can creep up to 10, 15%. And for retirees who are really focused on protecting what they have, even 15 to 20% can make a lot of sense.
Honestly, this is the perfect way to look at it. Gold isn't supposed to be the engine of your portfolio. That's what your stocks and mutual funds are for. No, gold is the insurance policy for your portfolio. It's the protection you have in place for when things go sideways. You hope you never have to actually use it, but man, when those storm clouds start gathering, you'll be so glad it's there.
So when is the best time to buy this insurance? Here's a simple 3-step checklist. First, the best time to buy gold is usually when there's fear in the market. When stocks are dipping and things feel volatile, that's often your signal. Second, if you're going for SGBs, you just have to keep an eye out for when the government opens new tranches for sale. And third, for gold ETFs, the smartest, simplest approach is to use a SIP. Just like with your mutual funds, buy a little bit every month. It averages out your cost and takes all the emotion out of it.
And all of this brings us to I think the most important takeaway. It's about really understanding the true purpose of gold in your financial life. It's a total mindset shift.
away from speculation and towards preservation.
And this slide says it all perfectly. You don't buy gold hoping to get rich quick. You buy gold to make sure you stay rich. It's about protecting the wealth that you've worked so hard to build from all the things you can't control. Inflation, market crashes, global uncertainty. It's not about speculation, it's about preservation, and in the end, that is the real golden rule.